One main difference between managerial accounting and financial accounting is the income statements that we use. Managerial accounting uses a different style. We break things down differently than financial accounting. Financial accounting uses what we call a traditional income statement. The traditional income approach separates product costs from period costs as required for external reporting reasons. Again, they follow GAAP. And when we follow GAAP, we have to break down our cost into product versus period. So if we're looking at just a basic traditional income statement from financial accounting, this is probably what you would see. You would see sales minus product cost. Typically, we're going to call those COGS, cost of goods sold. That's going to give us our gross profit. And then we're going to take out our S&A expenses or period expenses in this situation. And that's going to give us our net operating income. That's what we know from financial accounting. That's the most used one, obviously, because that's what we have to turn into the regulators, the SEC, the IRS, those kind of things. That's what they want to see because we're following GAAP. On the other hand, managerial accounting uses a completely different one. They use what's called a contribution formatted income statement. And what a contribution formatted income statement does is it separates the costs into variable and fixed for internal use purposes. This is not something that we're going to report out to external reporting uses, but it gives us more information. It gives us the ability to do more analysis by breaking it up in this way. So let's look at what a contribution formatted income statement looks like. If we were looking at this from an internal perspective, then we would see this. Again, we would start with sales. Sales is the first thing we're going to do. But instead of subtracting out our product costs next, we're going to subtract out our variable costs. It doesn't matter if it's product or period. Anything that's variable, we're going to include in variable costs. And when we subtract that out, that's going to give us this new term that's called contribution margin. That's a very important term that I'm sure you're going to learn more about later on in other chapters of your class. Then we're going to take away fixed costs. Doesn't matter if it's product or period, we're going to take away fixed costs. And then that's going to lead us to our net operating income. So both the traditional income statement and the contribution formatted income statement, they both start and end at the same place. They both start with sales and end with net operating income. It's just how do we divide the costs up? Do we do it in product cost versus period cost, which is the traditional approach? Or do we do it variable versus fixed, which is the contribution formatted income statement approach?